Corporate Finance OneNote Practice Problem. In this presentation, we're going to work a practice problem in OneNote related to a schedule of cash payments. Get ready, it's time to take your chance with Corporate Finance. Here we are in OneNote. If you would like to follow along in OneNote, you're not required to do so, but if you have access to it and would like to, we are in the 430 Schedule of Cash Payments tab in the Practice Problems section. Closing this back out, we're going to have our information up top, and then we're going to have like a smaller version of that information as we use it to work through the practice problems. We are now moving on to the cash payments now. So we're looking at cash flow or projected or predicted cash flows into the future. We're going to have a similar kind of problem as we had with the cash receipts, in that we may purchase things on account, meaning they might go through accounts payable in a similar way as the receipts or sales went through the accounts receivable, meaning in the case of a payable, we might pay for things such as materials. If we make inventory, we might pay for the materials or purchase the materials before we pay for them. So we may purchase the materials, record the bill in our books, recording accounts payable, showing the fact that we owe for the materials, but then pay for them in some future period, in some future month, resulting in that staggering process for when the materials would be recorded on the books and when the materials will be paid for in terms of a cash flow schedule. We will also typically have more categories to cash flow or outflows, because we typically pay for more types of things than we do for the cash inflows. So in other words, just like the income statement, we expect to have more accounts that are expenses than revenue accounts. However, we expect the revenue accounts to be higher, hopefully, than in dollar amount than all of the expense accounts is added together. Same thing here, obviously, with the cash flows. We're going to have more categorization of cash flows going out, but we hope that the inflows are higher in number than the outflows. Also note that you typically need to do this kind of in order. So your normal order for these kind of schedules would be the sales schedule to figure your projected sales, cash receipts, and then the cash payments is kind of the normal progression of these types of things. So we have the expected sales for January through April are going to be 510,000. The percent of sales for materials, we're going to say, are 55%. So 55% of those are going to be for materials, we're saying. Material purchases will be the same for January through April. So we're going to have the same amount of material purchases from January through April. And then we're going to say the material are paid for 1 month after the month of purchase. So we purchase the material in 1 month, they're going into accounts payable, representing a balance sheet account showing a liability account showing that we owe them, and then we're going to pay them the following month. The material purchases last December, 44,000. Labor costs for January, February, March, and April are going to be these amounts to the right. And then we have the fixed overhead costs, another cost, another outflow, it typically being fixed, which is kind of easy for a cash flow statement, meaning we're going to have like the same number going across for the cash flow budget or cash flow statement here, or the projected cash flow outflow. So then we're going to have our schedule that we will make, and we're going to have the same information up top. We're looking at a schedule of cash outflows, cash payments or outflows. We're going to have December here, even though that's not one of the periods we're focusing in on, because once again, we'll need December in order to figure out the January flows for purchases that were made on account, meaning they go through accounts payable. So first, we're going to start out with the material purchases, because those are the items that are going to go through accounts payable. We're going to say that we have the 44,000 for December, and what we're going to do to calculate this is we're going to take the expected sales. Well, December they gave us the 44,000. So the 44,000 is December, and then we're going to take the 510,000 for our range times 0.55. That means that we're going to have purchases related to the sales, and notice we might often have a nice tie of prediction between the materials we're going to purchase and the projected sales, because sales are going to be the unit sales times the sales price. So we should have a relationship between the sales and the purchases or the materials we'll use to make the inventory that we will be purchasing. So we're going to take the 280,500 and then divide it by 4 that gives us the $70,125 for January through March. So those are going to be our purchasing numbers. The payments then, we're going to say for the materials. So now these are when we purchase them. We're going to assume we purchased them all on account, meaning in December we purchased $44,000 of materials on account, and we're going to pay for it then in January, meaning accounts payable went up here. We entered the bill into our system. We got the materials, but then we didn't pay for them here until here, meaning cash went down. We paid the cash and we decreased then the liability on our books of accounts payable. We paid it off. And then January, we purchased $70,125 more of materials. We got the materials, entered the invoice into our, or the bill into our system, which increased, the materials, which would be inventory or expense, probably inventory here, and increased accounts payable. Then we paid for those the following February. We paid for those materials, decreasing the accounts payable, the liability showing we owe it, and decreasing cash as we purchase more materials for the same amount, $70,125, which we'll pay here in March, purchase more, which we'll pay in April, we purchase more, which we're going to pay in May. All right, and so that's going to be the most confusing part. And notice we can have different scenarios on this, just like we had for the receivables, meaning we might pay for some of them in the month of purchase and some of them the month after. It might take us 2 months if we might not pay for it in 2 months. So we'll look at some different scenarios based on this information in the future. This is kind of like the most basic starting point that we will have. We'll have some more complex scenarios in future presentations. Then the labor is given to us here. So we're going to say that there's going to be payments for labor, and they're just given to us January, February, March, and April. So these are going to be the payments that are going to go out with relation to the labor. Then we have the overhead. The overhead is typically something that's often fixed. And many things, when you think about your budgeting or your cash outflows, they might be fixed, like the rent or something like that. It's going to be standard each month. Those are going to be nice and easy for us to then predict into the future. The $32,000 is going to be all the way across. Notice that I'm not using the flows or calculating anything for December here, because I only want that number on the table so we can see how January's number came about with regards to the actual flows, the payments that are going out here. Then if we were to add these up, the $44,000 plus the $31,000 plus the $32,000 gives a total payment of $107,000. February, the $70,125, the $35,000, the $32,000, giving us the total of $137,125, and so on and so forth.